Hi, it's Eric Nuttall, the Ninepoint Energy Strategy. This is the first of what should become a weekly form of an update to recap the past week or so's events. Where we stand today as energy investors is effectively in a holding pattern. What we hear from the trading desks is that there's not profound selling pressure to explain some of the weakness we've seen in shares. It's more just energy investors sitting on their hands. We face a series of uncertain events ahead. I think the energy market awaits the response of Israel and Iran to see if energy infrastructure is actually hit. If so, is this the beginning of a tit-for-tat multi-month war? Will there actually be a supply result? And so until that's resolved, I think most people are just waiting on the sidelines. Secondly, we do have the US election in a few weeks' time. Most polls show that Trump is the front runner. We think that will have a positive impact on oil, given that the drill baby drill mantra effectively has no teeth. We do not believe the US president can affect a meaningful US supply growth. But at the same time, we think that Trump will be very hawkish on enforcing Iranian sanctions, potentially removing as much as 1.5 million barrels per day from the market. And while we think it is likely that the UAE and Saudi Arabia will step in to fill that void, I think given challenges with Trump Iranian policy in the past, they'll be much more cautious to wait for an actual impact on the supply. And then finally, we have the OPEC Plus meeting on December the 1st, seeing if OPEC begins the gradual return of barrels. Our bias as it sits today is that they will go ahead with that schedule. We have seen improved compliance from the chronic cheaters, Russia, Kazakhstan, and Iraq. We do, however, think that OPEC is keen to slowly bring barrels back on. Their expectations for demand growth in 2025 is a little more bullish than what consensus believes. And I think their view on the potential demand or supply growth, rather, out of OPEC Plus is a little more muted than consensus, which we agree with. As we look to consensus next year with a strip well below $70, we think expectations from certain areas of non-OPEC plus, such as the United States and even Canada, are a little too high. We've seen several service names report this week, both international and domestic pressure pumpers, all speaking to budget exhaustion already for 2024, and the view of flat to slightly down spending in 2025. And so we're challenged to reconcile that with expectations of growth out of the US as much as 800,000 barrels per day for crude and liquids. And so as we look to the balances of next year, we do remain bullish relative to consensus. We do think a reasonable range is roughly $70 to $80. The ongoing ability of OPEC Plus to very slowly, gradually return those barrels back to the market, ultimately bringing spare capacity down. We do not believe in an oil price above $80 because at any price approaching that, you will see a modest response from short cycle suppliers such as the United States, Canada as well, and also the increased return of OPEC Plus barrels. So in that context, 70 to 80, as we look at energy stocks today, which is a very, very contrarian bet, energy stocks, while performance has been fine, is underperforming many of the sub-indices as we have the US markets reaching all-time highs. And so the ability to bring that incremental net buyer into the market today is challenged. It's the reason why we are encouraging our holdings and energy companies in general next year to not pursue production growth. At a time when OPEC Plus has barrels off the market, it makes no sense whatsoever for energy companies pursuing meaningful growth. What they should be doing is pursuing no growth, maximize free cash flow, and use that to buy back their shares in an environment now where buying interest is challenged. We expect or believe that the energy sector using $70 next year, using $3.50 NYMEX natural gas pricing and other assumptions, is trading at roughly a 9% free cash flow yield. And so we remain bullish in the outlook for energy stocks, even at a current oil price today, which reflects perhaps the highest level of bearishness in history. Sentiment today feels even more challenged than during the lows in COVID, during the biggest demand shock in history. And so we remain bullish in the outlook for energy stocks, even with muted expectations for meaningful increase in the oil price, given the robust ability for energy companies to be able to buy back their stock. And so that's a wrap. That's it for this week. We'll chat again.